The minutes from the Fed Reserve's January meeting showed that policymakers are in no hurry to cut interest rates, given that the unpredictable actions of the US president could trigger another wave of inflation. This caution seems justified. However, this has led markets to focus more on the White House statements rather than the Fed's comments. Still, the key benchmark for traders remains the latest macroeconomic data. We are watching traders' calendar for February 24 and 25. Business activity in Germany remains uncertain. In January, the business climate indicator rose to 85.1 points, exceeding the December level. However, economic stagnation persists, and in February, the index may return to December levels at around 84.7 points. If the indicator declines again, the euro could shine even deeper. Inflation in the Eurozone appears to be accelerating. In January, it reached 2.4%, up from a 2.2% in December. Forecasts suggest further acceleration to 2.5% in February, potentially increasing pressure on the European Central Bank. If the data meets expectations, the euro may climb amid a lower likelihood of a rapid key rate cut. US economic activity is expected to remain stable. The Chicago National Activity Indicator rose to 0.15 points in December, moving out of a negative territory for the first time in 6 months. Forecasts for February indicate further growth to 0.21 points. If this scenario plays out, it will confirm the resilience of the US economy and support the US dollar. Texas manufacturing has also entered in recovery phase, a trend that began only 2 months ago. Before that, the state's manufacturing index had been in negative territory since May 2022. The indicator could jump to 18 in February from December's 4.5 points. If preliminary data confirm this forecast, the US dollar may gain value against its major counterparts. The gap between US and Eurozone economic performance is becoming increasingly evident. As the US economy expands, the Eurozone's weak data look even more concerning. Germany, in particular, is struggling to avoid recession. GDP growth stood at a minus 0.3% on a yearly basis in the second and the third quarters of 2024. In the fourth quarter, analysts foresee a minus 0.2%, which could hardly be called encouraging. Nevertheless, if the economy stabilizes as expected, the euro could see short-term support. Retail sales forecasts in the United Kingdom remain bleak. Since October 2023, the index has dropped from a minus 6 to minus 24 points. So sharp decline in consumer activity could weaken the British pound, dragging the euro down with it. However, the United States reports on this day do not favor the greenback. The house price growth is expected to slow down from a 4.3% to 4.2% in February. While the decline is small, the sector has seen 7 consecutive months of price drops, from a 7.5% in March to 4.2% in October. A return to lower levels would confirm this trend and put pressure on the US dollar. The decline in the US consumer confidence is also a negative signal for the United States dollar. The index may drop deeper in February from 104.1 points to 103.0 points. Please note that the time of publications is set in a GMT +3. The next video review of a trader's calendar will be released on Tuesday, February 25. And now we wish you profitable trading and see you soon.